Bitcoiners, welcome to a very special episode of the Bitcoin Magazine podcast. I'm sitting across from my stud colleague, LeClair, and Dylan just talked to the man, Greg Foss. I remember I had Greg Foss on the FedWatch podcast, and he was dropping so much knowledge about how Bitcoin is this insurancy against sovereign debt. And how he, used that mental model in order to value Bitcoin today at over $150,000 a coin. I think Greg is the man. I know that you think very highly of him as well, Dylan. Why don't you give the listeners a little bit of a preview about what you guys talked about?
Yeah, me and Greg. I mean, Greg is so experienced in credit markets. He's been trading on the street for 30 years. We really just dug deep into why the system is irreversibly broken. The leverage in the system, why central banks can't allow it to unwind. We talk credit default swaps, Bitcoin as a solution to it all. Talk volatility, a little bit of trading strategy, and maybe we leaked some alpha in the interview. So I think anybody tuning in is gonna thoroughly enjoy this one with Greg. He really knows his stuff, and it was awesome to pick his brain.
Yeah, I mean, I could second that again. Greg, I feel like he's really come out on the scene very quickly, but Bitcoin and Bitcoiners really believe in a meritocracy. And I feel like Greg's immediate recognition just kind of speaks to how much signal he's really pushing out. But with that being said, another place that, I've been personally working on increasing and amplifying the signals over at Bitcoin Magazine, bitcoinmagazine.com. Dylan, myself, a team of over 5, full-time hungry Bitcoiners are always constantly just trying to put the best inputs into Bitcoin Magazine and make sure that we're covering all the best news, covering all the best pleb posts, covering all the best just kind of like thought leadership in the Bitcoin space and doing Bitcoin justice. So if you're not already subscribed to Bitcoin Magazine, go to our website, subscribe to Twitter, subscribe to our newsletter, check out all of the amazing content that we're constantly pushing out. But until then, let's get into this awesome podcast with Greg Foss.
Hey guys, here with Greg Foss today. We're talking about Bitcoin in the macro environment leading up to Greg and the Bitcoin 21 discussion on the macro environment. So Greg, for those who don't know, you want to just give a brief introduction about who you are, your background, and your thesis in that awesome report you put up?
Sure. Well, hi everyone. My name is Greg Foss. I'm coming to you from Toronto, Canada. I have spent just over 30 years trading credit in my life. I was a high yield bond trader on both the buy side and the sell side of the street. The sell side is when you work for an investment dealer, like in the US, Goldman Sachs, JP Morgan. And then the buy side, I worked for 2 separate hedge funds where I became a client of the street. So I did a tremendous amount of trading with the likes of Goldman Sachs and JP Morgan. Our hedge fund successfully navigated the great financial crisis in 2008, which was largely, as everyone knows, a credit event. And in 2016, I decided to retire from the hedge fund business. And since then, I've been, in 2016, I got introduced to Bitcoin. And since then, I've become a full-time Bitcoin student. I have never seen anything as cool in my whole life from both a technological perspective as well as a opportunity to fix the financial system and the shortcomings in the financial system as I've experienced them and as I see going forward.
Awesome. Yeah. So for those who haven't read your report, I think one of the things with understanding Bitcoin or understanding the value prop is kind of understanding how broken the financial system is and just like irreparably broken, right? And understanding credit is kind of a deep rabbit hole within itself. You want to dig into a little bit about how or why it's so irreversibly broken?
Sure. So to start, I'm a mathematics guy. Everything I've studied and traded in my life typically is based on factual mathematics. As everybody knows, math is the base layer of language. In other words, whether you speak Chinese or Spanish, any other language in the world, everybody communicates in math as the base layer, and then the second layers are their native tongues. But I started as an engineer, studied in Canada, then went to the US and did an MBA in university, upstate New York, Cornell University. And I came back to Canada and I worked at Canada's largest financial institution. And I was quickly introduced to some of the shortcomings of the financial system. I was working for Royal Bank of Canada, and very, as honestly as I can say it, Royal Bank of Canada was insolvent. And that's a pretty eye-opening experience coming out of 2 years of business school and 4 years of undergrad, where you just are never taught any of these potential scenarios. Royal Bank of Canada was insolvent because it had lent too much money to lesser developed countries around the world. They were termed LDC. Primarily, though, those lesser developed countries were in South America. And the Royal Bank of Canada, if you had marked the value of the loans they made from the 100 cents on the dollar that they made the loans at down to the trading price of approximately 25 cents on the dollar, that mark-to-market loss would have vaporized their book value of equity. So that's the definition of insolvency. And Royal Bank of Canada was not alone. In fact, the entire global financial system was in the same shape. And therefore, Treasury Secretary Nicholas Brady in 1988 proposed what's called the Brady Plan, starting with the country of Mexico. And I had my job. I was working directly for the CFO. I had to come out just fresh out of school. I had to advise the bank as to what Brady Plan option we were going to take on $1 billion worth of Mexican debt. Now, $1 billion doesn't sound like a lot of money in today's day and age, but it was a lot of money back in 1988. And it was a big project for me. And, I was working directly for the CFO, and we made a decision to go 100%. We chose this par option. It was called the Brady par option. And everyone in the global banking system made their respective choice. And how it worked was, as opposed to taking a 5-year loan and having to write it down to market of 25 cents, Treasury Secretary Nicholas Brady very intelligently, together with his staff, determined a plan to change that 5-year loan into a 30-year obligation, and where the principal was backed by U.S. Treasury zero coupon debt. So the cool thing was, the banks did not have to write the loans down to market, because over a period of 30 years, the zero coupon portion of the guarantee would accrete to 100 cents on the dollar. It was a brilliant solution, a bit of accounting gimmickry, okay? And that's unfortunate. Well, it's not unfortunate. It was a very eye-opening experience for me. And I, from that day, was looking for a solution to what I term the fiat ponzi. Okay, now that was back in 1988. I didn't become a gold bug per se. I understood the applications and appreciated the value and the stored value proposition for gold. But in 2016, I was introduced to Bitcoin. And from that day, I said, wow, this is the solution to how can people have confidence in the global banking system if it becomes insolvent. So the global banking system was insolvent in 1988. It was again insolvent in 2008 with the great financial crisis. And it's my opinion, in 2019-20, it was again insolvent if you were to market the value of the loans on the balance sheets of the big banks. Now, I'm not trying to start a bank run. I don't want hate mail. I just want people to understand that when you have a banking system that's levered like the North American and global banking system is, that being said, it's levered to the tune of 20 to 25 times. That means for every loan that's made, there's only 4 to 5 cents on the dollar that is comprised of risk absorbing equity, and the balance, i.e. 96 cents or 95 cents, is depositors' money. Depositors' money, whether it's from their own retail banking system or it's interbank deposits, or it's subordinated debt as part of their capital structure. The point is there's only 4 or 5 cents of risk absorbing capital. How can people have confidence in that system? Henry Ford said over 100 years ago, he said, if the common American understood how the banking system really worked, there'd be a revolution in the morning. And what it comes down to is that's the leverage that's in the banking system. It's always been there. People, though, have confidence to be the depositor because why? Well, there's a little bit of deposit insurance, that's for sure. But the reality is everybody feels the banks are too big to fail. And that leverage being too big to fail means on a regular basis, the Fed does have to step in and rescue the system. And certainly that happened in 2008, 2009. And unfortunately, what happens then is the leverage in the financial system gets transferred essentially to the leverage or to the balance sheets of the federal governments around the world. And that is the danger in the system. Leverage is always the danger in the system, and leverage unwinds are always the painful result of a market drawdown. And when leverage gets pulled out of the system, well, we've seen it on a regular basis. Prices essentially collapse. The system doesn't function anymore. When I say the system, i.e. new issue product is impossible to raise for CapEx. If companies wanted to raise money in the public markets, the market's essentially shut. So that's the risk, Dylan. And I know the solution. I think that a lot of people know the solution. Some of them are afraid to admit the solution, i.e. they could still be in the legacy banking system. But the reality is that we have passed a point of no return because the total global debt divided by total global GDP is a factor of 4. Okay, total global debt is 4 times the denominator, which is global GDP. Now that's essentially your tax base. Well, let's put a coupon in the numerator, an average coupon in the debt of global debt. Let's call it 3%, which I think is a generously low coupon. And therefore, your debt balloon is growing at 4 times 3%, which is 12%. Means your denominator has to grow at 12% just to keep up with the organic growth of your debt balloon. That doesn't even include deficits that are added when governments say, well, we're just going to print another couple of $1 trillion. You know, the math is a certainty that fiats will debase because the only solution when you have a debt spiral, the only solution is to continuously print money. And when you continuously print new money to solve that equation, I call the fiat currency the error term. And that fiat currency as an error term will continue to debase. It's 100% certain. It's only based on mathematics. You can't fight math.
So to go back a little bit, you were talking about in the late 80s with the Brady plan and how basically there was too much debt, or the debt couldn't be repaid, so they lengthened the duration of the credit that had to be repaid. So since then, I guess just to put a little bit of context on it, around the world, but really, I guess the U.S. being the world reserve currency, I feel like also all the risk-free rates or the rates from other countries, you know, every credit rate in the world is kind of off of the U.S. Treasury, right. And so since 1981, but you know, there's been this 40-year secular trend of lower rates, right? So every time there was this sort of credit contraction,
yes,
what they did was they pushed down the discount rate. So now we hit zero. We hit the zero lower bound in the 08-09 crisis, right? And since then we really haven't gotten off of it. And so, yeah, it puts us in the position we are in today, where there's really like the amount that we can kick the can is no, you know, we can't lower rates anymore. So, yeah, just like, I guess to quote one of your things that I thought was really interesting and telling in your piece was, a bond investor doesn't really think how much can I make. It's more about how much can I lose. And so with rates at zero, I think, and a lot of people don't understand credit, but with rates at zero, the how much can I make is almost nothing, and how much can I lose is everything. So yeah, I guess how are credit investors thinking about this environment?
It's a great question. So, most credit investors have lived the 40-year bull market in bonds. When I say 40 years, you quoted 1981. When I first started trading, and I was trading before I got my first job, but when I first started trading, call it 1986, US 10-year interest rates were at 14%. Okay. There's been a 40-year downtrend in interest rates. A lot of it's because Paul Volcker successfully snuffed out inflation in the early 80s. And that rate decreasing has been an evolution of lower and lower reported inflation. Nonetheless, rates did bottom out in the 10-year space, as you mentioned, about last February, just after COVID, at about 60 basis points. That's 0.6%. So interest rates have gone from 14% to under 1%. And bond math is quite simple. First of all, there are no true capital gains in bonds, even though the price does change. As interest rates go down, the price of your bond goes higher, everything else being equal. But what happens if you sell your bond at a higher price? All you have to are able to do is take those proceeds and reinvest them in a new bond with a lower coupon. So over time, you've pulled forward your returns by cashing in higher coupon bonds for lower coupon bonds. The lower coupon just reflects the open market yield. And now it works in the reverse, because not even concerning ourselves with the credit risk of the US Treasury, of which there is some, but most people don't even think along those lines. The flip side is you need to worry about bond prices going down as interest rates go higher. All right. And simple bond math, you can see it in action over the last year. 1 year ago, Dylan, they issued a 1.25% 30-year US Treasury bond, which 1 year later, there's 29 years remaining, but open market rates have gone from the 1.25% in the 30-year up to 2.5% in the 30-year. Well, that increase in rates has cost the 30-year bond from 1 year ago over 25 bond points, i.e. the bond trades under 75 cents on the dollar. It's been forever in my career, I mean forever, that you have seen a US Treasury bond lose 30% of its value. It hasn't happened. But what happens if rates going forward continue to rise? And I'm going to quote Ray Dalio here. You better learn bond math. That's not his quote. I'm saying you better learn bond math. And his quote was, I'd rather own Bitcoin than a bond. And I agree with his analysis. There is very little return left for the risk that's inherent in all all bonds, including corporates, high yield, mortgage-backed securities, the whole gamut. There is an incredible amount of pricing risk in those bonds that my generation has never experienced, because it's been 40 years since a bond manager has ever experienced that.
Yeah. So I guess kind of going off of that a little bit, right now we're kind of in this environment where consumer price index for the first time, and we can debate the merit of the CPI gauge. But consumer price index is starting to creep up, and just anecdotally, everybody, Google searches for inflation. Everybody's, the cost of living is rising. obviously, and it does, it takes a fool to not notice that. And you see a lot of people, or maybe sometimes occasionally someone will say, well, in the 70s, they raised interest rates, so why can't they do that again? But what I think, and you're explaining this quite well, just the amount of debt in the system.
Correct.
Compared to 1970 or 71 or after that, when we came off the gold standard and Volcker crushed inflation by raising rates to almost 20%. Right now, there's so much debt that, there is that bond math where if the 30-year or all this debt that's out there that needs to be rolled over, if rates rise, everything gets crushed because there is that like convexity from the zero lower bound up. So just like, and I guess maybe going off Dalio's, announcement yesterday, how much of, do you think that's a big deal in terms of sentiment, or, kind of echoing your thesis? Because a lot of people on Bitcoin Twitter or just in this space are ahead of Dalio, we've been saying this thing, but Dalio coming in, $140 billion hedge fund, legendary investor. He rode that risk parity trade for the last few decades. Do you think that has a huge impact on the market, or just, the overall thesis of Bitcoin?
Yes, absolutely. And so firstly, I'm going to tell you that Ray Dalio is one of the most astute investors of our time. Yes, that risk parity trade was brilliant. Essentially, for the listeners, what risk parity meant was that he would have a portfolio of debt and equities, and according to the vol of each of those asset classes, he would adjust his portfolio mix such that if he was long equities, his hedge was long debt as well. Because generally, if equities went down in price, when there was a drawdown in equities, interest rates would go lower, and in tandem, therefore, the price of bonds would go higher. And that risk parity allowed him to smooth out portfolio vol and offer large institutional investors a pretty formulaic return at lower combined risk or lower combined volatility. It's a brilliant trade. He built a massive hedge fund on the back of that. But even he would admit now, okay, yeah, I rode the 30-year interest rate from, now I'm going to assume he started managing money right around when I did. Again, right around 14% down to under 1%. There's a lower bound on that. You would say interest rates can go through zero, which they have in Europe to the extent that I can never explain that, because if that was an asset at one point, because that's what a bond is in your portfolio, it is an asset. But once rates go below zero, they become a liability. What does that mean? Well, essentially, you're paying somebody to own that investment on your behalf. That's not an asset, that's a liability. So the reality is Ray has successfully navigated risk, built a huge business on it, and it is important to listen to very experienced people like him. But that's not a loud voice out there, Dylan. He understands the mathematics behind fiat debasing, because that's all a bond is a fiat contract. So let's say you make a contract where you're going to lend somebody $100 at time zero, and in $10, you want to get that $100 back together with a coupon that compensates you for the inflation risk and the credit risk of lending that $100. Well, you will, in the case of the US Treasury, very likely get your money back in 10 years, i.e. the credit risk on the US Treasury is extremely low. It's not zero, but it's extremely low. You'll get your $100 back in 10 years. The problem is the purchasing power of that $100, because it's a fiat, will have been meaningfully reduced. So you lend $100 at time zero. In 10 years, you'll be repaid your $100, but in present value terms, how much are you able to purchase with that $100 in 10 years? Substantially less than you would be able to purchase today. So you need to hedge that risk. That fiat debasing in a fiat contract is a certainty. We laid out the mathematics for that. You need to hedge that risk. And if you don't, well, the cycle continues where you are basically being taxed, right? That's what it is. It's a tax. and the government has fulfilled their obligation to pay you back the $100 that you lent them. But that tax is an implied devaluation, or not just implied, it's a devaluation of the principal amount that you lent them. And that's, that's the game. It's a very painful game, especially when interest rates are at close to zero, historical lows. So that's where we are. And the flip side of that is, and I'm going to quote Stanley Druckenmiller here. Stan Druckenmiller said the 10-year note should probably be around 3.5%. Right now it's at 1.6%, 160 basis points. It should probably be at around 3.5% if the US Federal Reserve was not in the market buying $120 billion worth of bonds a month. But if it even got to 3.5%, he said the US is in danger of losing their reserve currency status because 30% of Treasury revenues, tax revenues, would be used just to service the coupon on the debt, not paying down any outstanding debt, no, not paying any government programs, no, 30% of every dollar, 30 cents on every dollar would be used to pay down, or excuse me, to pay the coupon. That's at 3.5%. What happens if rates went back above 3.5%? And then the debt spiral just accelerates, okay? That's all it is. It's an acceleration of the debt spiral. DEBT spiral, we do not want it to become a death, DEATH spiral. We don't want that. What we do need is a parallel system in the form of Bitcoin, which will work as a store of value to protect you against that debasing.
So Greg, I have a question for you.
Sure.
I think I've heard you talk about this a little bit before with Preston or a couple other interviews. I think I've listened to mostly all of them, but so in these type of deleveraging events, right, where there is contagion in the credit markets, vol explodes, you have every risk manager going out and buying more protection, and it's this kind of, like you said in your paper, a negative feedback loop of risk. Like maybe what we saw last March, Bitcoin gets hit, and the narrative that was spewed out was because Bitcoin is this liquid global instrument, trades 24/7, and is quoted in nominal dollar terms. And so when there is this credit event where dollars are literally getting destroyed with how lending in the fiat system creates dollars and defaults or repayment destroys them, Bitcoin will get hit, in my guess, pretty hard. How do you think about that? And do you think at what point does a credit contagion event, at what point does Bitcoin not actually maybe get hit, but actually, explode upwards in that sort of event?
So that's a great question. And here's the reality is it's 12 years old, right? And so there's always two factors at risk. In a leverage unwind, what is a leverage unwind? Well, basically, it's when liquidity is being withdrawn from the system and your margin clerk comes over to you. You're running a hedge fund, you're using leverage. And sometimes you're not even using leverage, but your margin clerk comes over to you, or your cash clerk, and says, we're being redeemed. Okay. There's unit holders who want their money back. There's a panic in the system, and they want their money back. They just want to hold it, whether it's in their mattress or they think it's being held in a bank is the smart place to hold it. Long story short, that cash demand means you sell what you can, not always what you want to. You sell what you can. And sometimes that includes Bitcoin, particularly if Bitcoin has been a very strong performing asset in your asset mix. Sometimes your human nature is to crystallize those capital gains. So there is that pressure that happens. There's also the inexperience pressure, Dylan. It takes a long time for these narratives to take hold, where you shouldn't be selling this. You should actually be buying it at this point, but human nature, again, whether it's pushed by a margin clerk telling you, hey, Foss, it's time to raise some cash because we're being redeemed. Or it's the human nature, sell your winners just because you can. But let's say in another 10 years, this narrative is really the reverse, where a contagion event would lead to more demand for Bitcoin. I think it's like everything. It's an evolution of thought, of education, of understanding that. Let's look back at that event in March. Like, it didn't stay down there for long. And yes, it was a precursor to the risk off trade, but wow, did it snap back quickly. And people will learn from that, that, hey, you shouldn't be selling something like that, when in fact, if the system, the fiat system, is unraveling to an extent, you actually want to rush for protection, meaning you want to own Bitcoin. You don't want to be selling your protection. If your house, if you've bought fire insurance and your neighborhood is burning down, you shouldn't run out and sell your fire insurance. Your house is probably going to burn down as part of the neighborhood. You should be owning more fire insurance. That's what Bitcoin is. It's insurance on the fiat system. So when the fiat system becomes shaky, the narrative will be, in the future, in my opinion, you need to own more insurance, not less. You don't sell your insurance. You want to buy more of it. And that, this is part of an education process. I could very well be wrong, but everything that I've learned in 30 years is you buy more of your insurance when your risk is increasing. And when your risk is increasing because of contagion, because the financial system has gummed up, you should run. So there'll be I can't say for sure how the playbook will work, but it would be my opinion, you shouldn't be running and selling your assets to hold cash. You should be selling other risk assets to own the insurance, which is Bitcoin.
Brilliant. So I have a kind of another question for you. So
Sure.
Thinking about kind of like Dalio, where he has this risk parity trade where if equities sell off, there is this kind of deleveraging event. The Fed or all the central banks of the world come in and inject liquidity, and they squash vol, and it pushes rates lower. Well, at the end of this paradigm, now we're at zero, and we know kind of Bitcoin is this insurance on the whole game. What do you think about, and this may be more sophisticated sort of trade, but pairing a decently sized Bitcoin position with some vol, where in this environment, like vol explodes, you now have some cash to go buy the dip. What do you like? Are you positioning yourself this way?
You're a very smart young man. Do you think Mr. Dalio's not doing this mental mathematics in his head? Do you think he has not done this in his own personal portfolio, and they're running, whether they're running real portfolios or model portfolios based off of these outcomes and sensitivity testing and doing, you don't just do backward testing, you do sensitivity analysis going forward. I promise you he is. Okay. Why is he doing it? Because he's a pretty darn smart man. Yes, this is, you nailed it. I can't say it any better. So before, if his bucket trade was, between two silos, equities and bonds, well, let's just examine what he said. He said, okay, Bitcoin, I understand it. And then he said, I'd rather own Bitcoin than a bond. So did that mean he just took away that second silo and now it's equities and Bitcoin? I don't know. Doesn't matter. You can have more than 2 or 3 silos in a risk parity portfolio. Everybody should. Everyone thinks along the lines of your 60-40 model. Funny thing is, and 60-40 being 60% equities, 40% debt. Well, when yields are as low as they are, and think of your CalPERS at this point, okay? CalPERS, California California Public Employees Retirement System, I believe that's what CalPERS stands for, is the largest pension fund in the US, one of the largest, if not the largest. It has a target or prescribed rate of return of 8%, right? Well, think about it. 8% is a combination of 60% equity and 40% debt. Well, what is a proper return on the 40% debt in this yield environment? This is before defaults, but I'm going to throw out a number again, about 3%. So 3%. So 40% times 3% is 1.2%. That portfolio is getting from fixed income before defaults. So let's ignore defaults and just say, okay, 1.2% is coming from equity, from debt or fixed income. The flip side is 60% therefore has to make up the balance, which is 6.8% to get to your total 8% prescribed return, right? Well, what is 6.8% divided by 0.6? That's over 10 or 11% annualized return on equities for them to get their prescribed rate of return. What if, though, they threw in a third bucket, which is Bitcoin? And luckily, some smart academics have helped do that for us. Yale University has done that. And Yale has said, hey, guys, I don't care if you're a pension fund, if you're a family office, if you're a personal investor, you should own between 6 and 8% of your portfolio in Bitcoin to get optimal portfolio returns and actually reduce portfolio volatility. That's a big number coming from a smart, asset allocator, academic asset allocator. But boy, that's a lot of money that should flow into Bitcoin. And then I believe, if I'm not mistaken, they tell you to take that 8% out of your fixed income bucket. So what would it mean? Well, maybe you've gone from 60-40 to 60-32 and 8, the third silo being Bitcoin. Hey, as a risk manager my whole life, I certainly understand the benefits of that. I guarantee you Mr. Dalio does. He's funny, right? Because he can't tip off the world that he wants to do it for his own fund. 140 billion, let's say he wants to do 10% in his portfolio. Well, let's do some mental math there. He needs to buy $14 billion worth of
that's moving the market.
Okay, well, especially because Elon bought 1.5 billion and the world went crazy. Like, can you imagine if Ray Dalio actually moved and came out and said, now, is he doing it behind the scenes? I bet you he's doing a little bit. I'm not going to tell people he's admitted he owns it personally. How about this, though? I'm certain across the world's pension managers and central banks, somebody is doing it. And when that news comes out that somebody has reached their allocation and is prepared to announce it publicly, it's my opinion that it will start a chain reaction of closet indexers, I'll call them closet indexer funds, that will want to do the same thing.
Super interesting. Kind of similar to Dalio, you have renowned investor Michael Burry, who, funny enough, made a killing on credit default swaps in the 08-09 crisis came out. And I think earlier this year, a couple months ago, he was making comparisons to Weimar and about, warning that hyperinflation, while it's not here, it may be coming. And there was an announcement the other day when his hedge fund disclosed their holdings that for the inflation bet, he was shorting treasuries. And so your kind of credit default swap thesis and model is based on the probability of a sovereign default and how much debt and unfunded liabilities there are, and kind of assigning a price for Bitcoin based on that. But I'm interested to hear if central banks come in and when they come in, when there is this next deleveraging and they monetize probably unfathomable amounts of debt and the balance sheets explode. While that, I think in nominal terms, treasury bonds will appreciate, the yields will get squashed, and maybe volatility comes back in. So I think like treasury bonds and shorting them based on inflation expectations is the right move if there was a free market. But
great question. Well, here's the
we're not in a free market.
We are not. That is correct. Michael Burry, I'm certainly not going to tell him, how to invest. I mean, we both lived the same side of the trade in 2008, 2009, meaning I owned more insurance on credit. Therefore, I would profit and our fund would navigate a credit induced event. The neat thing here, Dylan, that people have to understand is that a 10-year US Treasury rate is made up of two components. One is an inflation expectation, and the other one is a credit risk. And the whole basis of my career is when contagion happens in the market, it won't impact credit interest rates or interest rate risk or inflation risk, but it does impact credit risk. Okay. If the CDS, the credit default spread, swap spread on the United States expands meaningfully because of a concern, not just in the United States, but globally, that sovereign credit is becoming a more risky asset class. And trust me, it's becoming more risky on a daily basis because people are doing the math that we already did. And if this was a corporate bond, I'm telling you, the credit ratings of the United States Treasury would be solidly junk bond credit ratings, but they have the ability to print money. So, but a contagious event could happen in, a G20 country like Turkey or Argentina, which are already being reflected in the credit default swap market. But the flip side is, what happens if it happens in a G7 country? What happens if Canada doesn't get our house in order? Our house is a mess right now, okay? We are in way worse shape than the United States. Our economy is just 1/10 the size of the US economy. Based on population, that's just how big we are. So we're about the size of California. I mean, a meaningful economy, but we're not diversified like the United States. And our credit default swap spread is meaningfully wider than the United States, despite the fact, strangely, well, strange is a reality, we have a higher credit rating by S&P than the United States has. But the CDS markets, which are truth, shows us to have the insurance premium on Canada's substantially wider than the US. In fact, Canada trades as a single A equivalent type of rating. All I would say is this: if Canada becomes meaningfully more distressed in the global credit markets, and eventually, and God forbid this happens, but eventually Canada does default, do you think that wouldn't have knock-on impacts on its largest or second largest trading partner in the world, which is the United States? Like, of course it would. And these types of contagion events cause credit spread widening. And when these spreads widen, interest rate in expectations or inflation expectations could be going in the other direction, but net, there might not be a change. I would argue, Michael Burry, it's funny that he's taking a negative view on the US Treasury inflation concerns, but he's not doing it in the CDS market, or maybe he is, and he's just not saying, hey, I'm not allowed to do it again because I did it so well in 2008, 2009, I might get thrown, to the dogs. The point is, you got to look at the two components of the 10-year yield spread. Again, one being inflation expectations and the other being credit risk. There is, with each successive, as I mentioned, the global financial crisis, all it did is take the over leverage of the financial system and transfer it to the balance sheets of the US Treasury and the other governments around the world. This will be reflected in wider yield spreads going forward. And that is where you have to look for the real free market evaluation of risk. That's the basis of my paper. That's the basis of my evaluation as to an intrinsic value of Bitcoin. And look, inflation expectations will just accelerate the debt spiral, right? Because the coupons will increase and your organic growth of your debt balloon will also expand more quickly, because a higher coupon, everything else being equal, requires more tax revenues to service that higher coupon. There's so many ways this could play out. All of them lead me to believe that you need to own Bitcoin as a hedge. I'll stress again, I don't want the system to fail. I believe there needs to be a parallel system, one which is a store of value called Bitcoin, one which is a currency which facilitates international trade, all the things that currencies are good at. And let's be honest too, if the government wants to print more money as a short-term solution to ease social burdens, that's okay. You can never print yourself to prosperity. That is a mathematical certainty. but can it ease the bumps along the road? There's no question it can. I mean, did the Fed do the right thing in 2019, 2020? In my opinion, yes, they did the right thing, but the costs of it will be borne on future generations. And that's what you need to hedge.
Dual question for you. So one is, and I think you just maybe answered it. If you were a central banker, head of the Fed or the ECB, what would you be doing, if anything, differently? And two is, what are your thoughts on the recent kind of development over the last year of foreign central banks and nations being net sellers of treasuries for the first time in almost 4 decades? And what are the implications of that for the dollar as a reserve currency?
So I'll answer your second question first. I'm just going to go to Stan Druckenmiller, who honestly is another absolutely phenomenal global macro investor. Another one, I don't say like myself, I mean like a Ray Dalio type. Okay, you got to listen to these people. I'm not the one that say that within 15 years the U.S. is at risk of losing its global reserve currency status. That was Stan Druckenmiller that said that. What are the pre-indications of something like that happening? Yeah, you start selling down your reserve, your treasury, U.S. Treasury holdings. You start planning as a central banker from another country. You'd be smart to do that. You'd be smart to increase your store of values. Canada has no gold left. In 2016, I think we sold all our gold. And okay, so I'm going to move to your first question. What would I be doing as a central banker? Let's assume that I actually wanted that job, which I promise you I don't want. What would I be doing as a central banker? I wouldn't have been selling my gold, okay? I will call them out for that. And what else might I be doing? What do you think else I might be doing? I might be looking for other store of value assets that would replace the US as reserve asset, okay? And this is part of my thesis as well. When energy markets become priced in Bitcoin, there will be a natural movement away from the US dollar as reserve asset as well, okay? Not only will it be a reserve currency move away, but also as a reserve asset. And digital energy, which is Bitcoin, it just seems logical to me that oil and other energy should be priced in Bitcoin. If a natural resource rich nation like Russia is selling their valuable natural resources for US dollar fiat, that's not a good trade. But what if they were selling it for digital energy, Bitcoin? That's sort of a smart trade, in my opinion. You sell natural energy for digital energy. Digital energy is Bitcoin, which is a store of value or a technology that will reward you in the future for your work or time or energy expended today that you want to consume in the future. This is the first law of thermodynamics for all engineers. It rings true. You don't only have to listen to the smartest guy in this room, which includes the Bitcoin room, which is Michael Saylor. All due respect to the other very smart people in this room, but Michael Saylor got it. And not only did he get it in size, he explains it so eloquently, right? So do I ever want to be a central banker? Gosh, it's not an easy job. Would I want to be a central banker so that I could help future generations of Canadians? Because I think that the corner that we've painted ourselves in right now is there's very few solutions. Yeah, I would take that job. It would be a very difficult job, but it would include, and I'd have to have a mandate of open thinking, open-minded thinking that allows you to reverse some of the dumb policies that you've been enacting in the last few years, including selling all of our gold, including some of these statements by federal politicians in Canada. The budget will balance itself. Okay, that was by our prime minister. If you were a CEO of a company that said that to his stakeholders, I don't know. He shouldn't be in that. That CEO should not be in that position very long, because budgets don't balance themselves, Mr. Prime Minister. Okay. And this is very, very concerning for future generations of Canadians. And so I wouldn't want the job, Dylan. I would take it because I think that there's not enough smart thinkers up on Parliament Hill in Canada. I do have a conservative guy that I would put in that chair. I think a lot of people know who I may be talking about. He gives me hope that there are some rational minds in the House of Commons in Canada. This is not a drill, ladies and gentlemen. It's mathematics. It's not about a popularity contest. Printing money is a pretty certain way of getting more votes than someone who goes up there and says, I'm not printing any more money, and plus I'm going to double your taxes. Well, it's too late. Even if you doubled our taxes, it doesn't solve the mathematical problem. So, but pretty sure the guy that's going to print more money has a better chance of running or gaining a second term of office, right? Yep. So you have to balance that against the discipline that's required in a central banking function. Maybe I could get you and Will Clement to be the kids that run these types of things. I'm too old for that, but you know what? I do still care about as much about the future as you two guys do. So
appreciate the kind words. All right, I think I'll ask you one last question, and then we can wrap it up.
All right.
Do you expect any? Well, maybe it's the Dalio types, but maybe on the corporate side, do you expect more Michael Saylors who see this opportunity and lever up with basically negative yielding debt, at zero coupon, and Saylor offered convertible notes, but really just speculative attacking the dollar, seeing the opportunity cost of acquiring Bitcoin as an asset versus, melting ice cube bonds as a liability. Do you think we're going to see more of that in 2021 or into the future? Because someone like, you can, fiat is created through lending, right? It's created through credit. And so I think maybe as the system starts to unwind, or if Bitcoin starts to really explode, it's probably on the back of maybe a commercial bank, but there's a lot of regulations there, but maybe, some funds that borrow $10 billion at near nothing.
Gosh, it would be the greatest trade ever. All right. There's been the book is, there's been titles of that book, The Greatest Trade Ever, right? It typically goes in the opposite direction, meaning, the greatest trade ever, you're short, you've purchased protection, you're short the market, you're long volatility. Those tend to be the greatest trades ever because, vol will tick down for 5 years, but then when it spikes, the expression is you take this. Yeah. You take the staircase down and you take the elevator up, right? I mean, that's what vol does. So you take the staircase down, you take the elevator up. And when you're long vol, and the elevator goes up, you saw what Bill Ackman was able to accomplish by being long default protection on an index of corporate bonds in the United States. It basically hedged his entire equity exposure, and he crystallized a huge capital gain by astutely purchasing default insurance before the word got out that, wow, things are really going to get ugly, right? So that's what smart managers are paid to do, is anticipate the future and try and anticipate the future, but also pay a reasonable price for the insurance. So, here's what I do know. There are a lot of smart CFOs in the global credit capital markets. Okay. And a smart CFO that takes the opportunity to borrow it at historically low rates and fix the term, meaning you're not just borrowing for a few months, you're borrowing for 10 years or so. You lock in your term, you can take the proceeds of that debt financing that you've undertaken, and you can do it whatever you want. I mean, under the veil of general corporate purposes, if that means using it for Bitcoin and acquiring Bitcoin for your treasury, yeah, there's guys that need to be doing this math. Mr. Saylor did it with a convertible note and essentially reduced that coupon down to zero. What would his coupon have been if he didn't use a convertible note, meaning convertible into equity? It probably would have been around, I'm going to guess around 2% over US Treasuries. It would have been a spread of 2% over US Treasuries. So, there's different ways of accomplishing getting money in the door at a fixed rate, whether it's with straight debt or convertible debt. But then the key thing is, what do you do with it? And yeah, I think there's people that should be doing it. Should a country do it, Dylan? Yeah. In my opinion, yeah, countries should do it. They're not knocking on my door to be the central bank governor of Canada. and I'm sort of happy about that. But listen, I would, I've spent my whole life trading credit. I do know that when the perception of risk is lowest, meaning spreads are as narrow as they are right now, actual risk is highest. Okay. And the flip side is, when the perception of risk is highest, meaning vol is trading at, above 70% annualized and nothing works. And well, actual perception of risk is highest, but actual risk is lowest, meaning prices have already fallen to levels that are now compensating you on a go forward basis for the risk that you're taking at that time. So it's always a game of, there's an expression, you can't suck and blow at the same time. But what you got to be able to do is take advantage of what the markets are giving you at various times. And right now, the markets are flush with liquidity. People are reaching for yield. If you're a CFO, you should take that liquidity advantage. You should issue term debt. And part of your use of proceeds, in my opinion, whether it's 6% of those proceeds or, whatever percent it is, you put some of it in Bitcoin or all of it. That's a pretty smart use of proceeds. And I would not just advocate it for the CFOs of publicly or privately traded companies. I would advocate it for CFOs of your personal finance, i.e. you, Mr. and Mrs. Jones. Well, you're the CFO of your family household. You should be doing the same. Whether you actually borrow the money or you just have cash on hand, don't keep a store of value. Don't use cash as a store of value. Cash is for liquidity, but take some of that cash if you're using any of that cash as a store of value, that's not the proper use. Flip it into something that is a store of value. And Bitcoin belongs in that general basket. I'm going to quote Robert Breedlove here. He believes there's $250 trillion in the world that are a store of value asset. So what would that be? It'd be like real estate, right? Gold, fine art, all of that stuff adds up to 250 trillion. And Bitcoin's still under $1 trillion. It's 1/250th of the store of value assets in the world. Good Lord. If you're a risk manager, or if you're a guy that plays, one of these things is not like the other, right? What are you going to do? You go to the one that's less than $1 trillion. Plus, it's the most beautiful technology you've ever seen in your life. It's transferable, divisible, help me out here. Transferable, divisible, portable, everything that you love about Bitcoin. Scarce. Oh, thank you for that one. I mean, it's a 21 million math and code, and it's less than $1 trillion. And the total of that pie in the world right now is US dollar 250 trillion. Oh,
it's like what Paul Tudor Jones said. It's
you bet on the fastest horse. So yeah, you always do probabilities. You don't put it 100% in. You play probability. You do expected value analysis. Number go up. Probability number go up is high. It's not certain, but it's greater than zero that the number go up technology will overcome some of these short-term volatility, some of these short-term FUD that we're experiencing right now. I'm looking forward to the Bitcoin conference to learn more, to meet young kids like yourself that see the future and want to make the world a more egalitarian place. also a more exciting place. The number of things that can be built on the Bitcoin blockchain going forward, the number of applications, layer 2, the Jack Mahlers of the world, layer 3, eventual smart contracts being built on the Bitcoin blockchain. This is so good for my kids. Why? Because the stuff that I have left them, me being part of society for the last 30 years that has done nothing but increase the debt, and I'm going to pass this on to my kids. I don't feel that good about my generation pulling forward all future benefits to my generation at the expense of my kids. I better do something to try and help my kids overcome that math. And this is going to be my part, which is for the rest of my life, I am going to be dedicated to the Bitcoin community to try and right a wrong that has happened for the last parts of my life. The wrong being, hey, let's just keep printing fiat. It solves problems, but it's not a store of value solution. So 2 parallel systems. We don't need to hope that one system breaks to the benefit of the other. The 2 systems should exist in parallel. People should be educated about it. We haven't even touched on the energy FUD, but all of this comes back to the first laws of thermodynamics, the rule of conservation of energy. I'm looking forward to the future, or helping the future for my kids, for young kids like you, Dylan. I'm looking forward to your leadership, and very much looking forward to meeting a bunch of people in Miami, because I've learned a ton from the community.
Greg, I really appreciate you coming on. Miami's gonna be a hell of a time. We'll have to catch up and grab a beer together, and I might have to go and hedge with some vol. I might have to go grab a little bit of protection.
Well, it's you got to own, credit.
Got the Bitcoin part covered.
Well, here's the neat thing though. When you are long credit, you're short volatility. So think of all the credit managers in the world that are short vol. Why is there such a puke when vol spikes? Because everyone's shorted. So it's running in their face. They're getting crushed on all angles. It's always nice to have things that actually benefit from expanding vol. And over time, that will be Bitcoin. In the short term, are we certain that there couldn't be a strong correlation in a risk-off trade? We discussed that. Long term, let's talk in 20 years. Okay, we'll rerun our correlation analysis in 20 years. I think there'll be some substantially different opinions. And this will be left to the guys like you. In 20 years, I won't even know how to use an HP12C. I bet you don't even know what an HP12C is. Hey, I want to show you one thing really cool. This is an HP12C. This was the financial calculator that I grew up using. I happened to go, stay with me for one sec. Are you guys still here? My granddad had this thing in his office. Okay. This thing is a mechanical calculator. It's called the Curta. Okay. This is a salt or pepper grinder mechanical calculator. You can do square root functions on this. 1955, Kurt Herzog, I think that's his last name. In the Second World War, he was interned in a concentration camp. He was an Austrian Jew who was interned in the concentration camp and was working on his project, but he didn't tell the Germans his all of his secrets, because they figure there's a chance that if he had taken his mathematical calculations using this calculator or some generation of that in the Second World War, they could have changed the gyroscopes on their V2 rockets, and it could have changed the war, because the V2 rockets were just coming in. This was extremely good technology that the Germans had. Their aim wasn't that precise, but the technology of sending a rocket across the English Channel to bomb England. Well, this guy didn't give this technology to the Germans. He went on, and in 1955, this was the mechanical calculator. Okay, so look, 1955. You still with me?
Yep.
Wait, okay, I'm back. 1955. This calculator was 1985. Okay, that's the HP 12C. 30 years later, 30 years after this, what do we have? It's called Bitcoin, knuckleheads. It's called Bitcoin. Okay, the most beautiful financial innovation that I've seen in my lifetime. Okay. And this was my granddad's, this is mine. And what are my kids going to be using? Well, you just picked it up. Okay. That is how things change over time. And yeah, you should look this up on YouTube. This was the coolest thing. It can do square roots.
Fascinating.
It is fascinating. Okay. And that's what we have. So keep studying math and keep appreciating the technological advances of civilization.
Bitcoin's a beautiful thing. I think on that note, we'll close this up. Thank you, Greg. Really appreciate your time.
It was a pleasure. Thanks for having me. I'll see you in Miami.
See you next week.